What is extrinsic value in the options concept? Extrinsic value simply means it's a time value for the option contract. Welcome back to Bull Bear Logic, day 8 of our option trading series. Before we jump into the topic, please remember I'm not a financial advisor. I'm making this content only for educational purposes only. Last week we discussed about intrinsic value. Today we'll see extrinsic value. So in this option chain, if you see the contracts which are expiring soon, the premium is cheaper. And where you see the same strike price, the premium is expensive. Intrinsic value means what? Stock price minus strike price equal to intrinsic value. But here stock price and strike price, the difference is 4.83. So the premium should be 4.83, but here we are seeing 12.80. So that extra amount, around that $700 change or close to 800, which is the extrinsic value we are paying. And if you see, that extrinsic value should be more for like a longer expiry dates. This is 257 days out and the premium is 32.75. We'll see with the real example. And extrinsic value simply means time value. And if we take again same NVIDIA, and the strike price of NVIDIA is $200 and the strike we are going to take 195, and it's a call option type. So when we calculate intrinsic value, and remember we paid for this contract, imagine $10. So now we'll calculate both intrinsic and extrinsic values. Intrinsic value means the current price and the strike price, which should be, it is around $5, which is $500. But additional $5 we paid for this extrinsic value. As extrinsic value equal to this option premium minus this intrinsic value. So this we are paying for this time, and this extrinsic value will be more for the longer dated options. Hope now you understand the intrinsic and extrinsic value, how we need to calculate for the option contract. And option premium, again extrinsic value plus intrinsic value plus extrinsic value equal to our option premium. And extrinsic value we also call as a time value. So because we are giving more time for that stock to move higher, and more time means generally more price, more extrinsic value. That's why as I showed earlier, like 1 month out expiry is expensive, but if you see 6 months out, even more expensive, 1 year out, even more expensive. And sometimes higher implied volatility also will increase the extrinsic value. And the implied volatility generally we expect, if the stock is expected to make a larger moves, buyers are willing to pay even more than the extrinsic value. Then the extrinsic value will increase and the overall option premium also will increase. And we can expect those implied volatilities around Fed announcements, Fed meetings or earnings or any geopolitical news. If we see this implied volatility will come into the picture. And again, time decay. This time decay we'll discuss in the later videos, how the premium will change from 30 days to 15 days to expiry date, how it will reduce. Hope now you understand the difference between intrinsic and extrinsic value, how we can calculate these two with our option premium. In our next video we'll discuss about how option price premium prices will move. And if you like this video, please like and share with your friends, and don't forget to subscribe to my channel for more interesting content. Happy learning!